So first let's start talking about lease workouts. So most of the issues involved in lease workouts, they're issues of timing. And so I just wanted to say a quick word about um, what the general timing rules are for when the lessor takes rent into income and when the lessee gets to deduct their rent. And so the timing of those items depends on the taxpayer's method of tax accounting. And so for a cash method taxpayer, rental income is taxable when received. Rental expense for the lessee is deductible when paid. There's a special rule about prepayments, but those are the general rules. You just sort of follow the flow of the case. Accrual method taxpayers, though, it's a little trickier. Rental income for the lessor is taxable the earlier when it's due or when it's received. And then for the lessee, it's generally deductible when due. So it's a little bit of a, heads I win, tails you lose situation going on here with the IRS. But what I want to point out is, especially for accrual method taxpayers, which is going to include most medium, large size businesses, that rental income is taxable when due, even if you haven't received it yet. And so that can cause problems for lessors, especially. And then for lessees, I mean, they're not generally not going to claim the deduction until the rent is paid. I think even for an accrual method lessee, once you get in a distressed situation, you're not paying rent, I think the deduction is going to be start to be problematic. But just keeping those rules in mind. So here's a few different lease workout alternatives, which I'll talk through just briefly. So the first alternative, I don't want to say it's the do nothing approach, but it's the no rent relief offered. So if the tenant is struggling, the landlord can just insist that the tenant pay as required by the lease, right? Putting aside, other issues, whether that's smart business decision or anything else, it could cause tax problems for the lessor if the lessor is an accrual method taxpayer. Because remember, what I just said was that the accrual method taxpayer has to take rent into income when it's due, when it falls due under the lease, even if it's not paid. And so if you have these payments not being made until the following year, best case is landlord has rental income for tax purposes this year, but doesn't get the cash till next year. So that's sort of, it's not great, but that's the best case. Worst case is the tenant continues to struggle. The tenant goes out of business and that rent is never paid, right? And it's never received by the landlord. And so the landlord's remedy at that point is they have to try to claim a bad debt deduction. They try to write off the rent. And that's perfectly allowable, but really it's a high standard you have to get to before you can write off the rent. Really, you have to pursue all your collection, all potential remedies, and there really has to be no chance of getting that rent. And you can get into tricky situations there because if that's sort of a subjective issue, right? So if you deduct it too early, the IRS can come in and disallow it, say you should have taken it in a later year. If you take it too late, in a real extreme situation, the IRS could say, no, you should have taken it earlier. Statutes closed, you can't take it. So this can be kind of a troublesome area. There is an exception to the accrual rules. That is, basic rule, you take it into income when it's due. The exception is, if there's substantial evidence that makes it reasonable to assume that the rent is never going to be collected. It's not enough that it's just going to be late. It's that it'll never be collected. And this is a lower standard than required for actually writing off the rent. But you still have to have some basis for it. And this is all determined as of when the rent is due. Okay, so there are problems with not working with the tenant to try to come to some agreement. So another alternative is the landlord could apply the security deposits to the delinquent rent. This isn't a great strategy from the landlord's point of view because really they already have possession of that deposit. So they're just moving the money from one pocket to another and they're paying tax on it. For the landlord, for the tenant, it sort of makes sense. Maybe it could buy them some time and then they could replenish the deposit later. But so that's an option. I don't see it a lot. The more common situation is that the landlord and tenant, they agree to enter into some sort of amendment to the lease. So it's, some sort of lower rent now in exchange for higher rent later. And I've seen this done in a number of different ways. You could say, okay, no rent's going to be payable for the next 6 months, and then we'll add 6 months of term onto the end of the lease. All right. I've seen other things. We can no rent payable for the next 6 months, and then we'll just take that amount you paid over the next 12 months next year, something like that. So it's some sort of amendment which provides for lower rent now in exchange for higher rent later. And as long as this is drafted properly, you could take advantage of that rule that says rent accrues as it falls due under the lease. And so this requires some amount of careful drafting. Typically, what I would suggest saying is something like this deferred rent amount, whatever it is, say this amount of rent shall not accrue or become payable until some later time, unless the tenant defaults. Deferred rent, abated rent, I see a lot of those terms tossed around. Those generally don't have a fixed meaning in the tax law. And so that's why I suggest being specific that it shall not accrue or become payable. Also, you could, if the tenant defaults, you could have a provision that accelerates that deferred rent. But phrasing here is important too. It should be phrased as, the rent is deferred unless the tenant defaults. The alternative, which I've seen people do, is they'll draft this lease amendment that'll say, if the tenant, stays in good standing on the lease, then the rent will be deferred. And I think that phrasing caused a problem. In the drafting, you should really make the deferral the baseline, and the acceleration is something that happens if the tenant defaults. It's also sort of a it's sort of a sidebar issue, but amending the lease can get out of certain 467 recapture problems. If you don't know what that is, you should be happy, but it's something that happens when you have long-term leases with fixed increases in rent. Amending the lease in this way could help you get out of that. But if that's one of your issues, we could talk about that. Another alternative, the landlord could just take a promissory note from the tenant in exchange for deferring their payments. Essentially, the landlord is just financing the tenant's payment of rent to the landlord. Sounds a little weird, but where that would get you tax-wise is the landlord's not getting any cash right away, but the landlord is paying tax on that rental income. The payments would be made later pursuant to the note. This would also allow the tenant to claim the rental expense as it accrues, even though they're not paying until later. So you'd have to be careful in setting it up as a true loan transaction. There should be a promissory note. You should, as much as possible, have loan remedies be the consequence of default under the note, not lease remedies. So I don't see this a lot, but I was working with a client recently. I sort of tossed this out there as one of my zany ideas, and he actually liked it, which kind of surprised me. But his situation was he was getting ready to sell the property. He didn't think this deferred rent amount was going to be taken into the purchase price one way or another. So he was happy to take the note, and that he would collect that after closing on the side after the sale. So this does have some place. And speaking of sort of zany tax ideas, this is more complicated, but you could set up what's called a Section 467 deferred rent lease. And what that means is you could draft the amendment so that you have a separate payment schedule and separate allocation schedule. So in an extreme example, let's say we had a 5-year lease, you could allocate $100,000 a year per each year of the lease, but you could have a payment schedule that says, despite these allocations, the payment doesn't have to be made until year 5. But if you structure this appropriately, this would cause the landlord to have the income according to the allocation schedule, so $100,000 a year. Tenant gets the expense per that schedule, even though it's not paid until later. So this is much like the promissory note example, except the whole financing is built into the lease. You preserve lease remedies and all that kind of stuff. I don't see landlords too interested in this because it's causing them to have to take income pay tax on it before they receive it. But there could be some negotiation between landlord and tenant in terms of those, the income and deduction. So I don't know, it's a possibility, but it tends to be too complicated for most transactions. Okay, so moving on then to debt workouts. I'm going to focus mostly on issues for borrowers. That's where most of the issues are, but I have some comments for lenders too. Okay, cancellation of debt income generally. People have some problem understanding this, but just generally, when you borrow money, that's not taxable income to you because you have an offsetting obligation to repay it, right? So if that obligation to repay is removed, that's what causes a COD income. So I think if you look at it like that, the whole concept of COD makes sense. I think the problem people have with it, just sort of on a gut level, is the whole reason that you're being relieved of debt is that you're struggling financially, and so it seems unfair to be hit with taxes for that. And the taxes can be very high. I mean, COD income is ordinary income, which means for federal tax purposes, there's a maximum 37% rate for individuals, maximum Hawaii rate of 11%. So that's what, 48%. And then, there's some cases where that 3.8% federal tax surcharge applies, and then you're over 50%. So congratulations, you've been relieved of $1 million of debt. Bad news is you got to pay $500,000 to the government. So I think, the IRS does realize that. And so in the regulations, there are some exclusions, which we'll talk about. COD income can be triggered by lots of different things, some of them obvious, some not so obvious. The first one, which I think it's on the obvious end, but the regulations are real complicated when you read through them, is if there's a substantial modification of the debt, that can cause COD income. So what happens is there's a substantial modification under the IRS regulations. The borrower is treated as issuing a brand new debt instrument in exchange for the old instrument. And the borrower will have COD income as a result of that pretend transaction if the issue price of the new debt is less than the outstanding amount of the old debt. In the vast majority of cases, issue price of the new debt, it's just the stated principal amount. There's different rules if you have publicly traded debt, and that's a whole nother issue. Generally, if it's a debt under $100 million, you're not even going to get into that. There's other rules that come into play if you're doing weird stuff with the interest rate, making it real low or making it not payable regularly. But generally speaking, as long as you're not messing around with the principal amount or the accrued interest, there shouldn't be any COD income to the borrower as a result of a modification. Just real quickly, substantial modifications can include a lot of things, not only changes in principal and things. It can be triggered by other things such as changing the collateral, changing the obligor. In most cases, that's not going to be relevant for the borrower, but it could cause problems for the lender, and we'll come back to that in a couple of minutes. But so just general rule from the borrower's point of view, if you're reducing principal or accrued interest, that's going to result in COD income. Otherwise, probably not. And so just a real simple example, Fred owns $5 million to the lender. Lender agrees to defer payments for 2 years. There's certain safe harbors for temporary forbearance, so that deferment of payment for a couple of years probably isn't a modification. But adding his father, you add his wealthy father as a co-obligor, that's a substantial modification. It's treated as this issuance of a new debt in exchange for the old debt. But if there's no change in principle, that exchange shouldn't be a problem. If in that example, though, principal is also reduced by $1 million, the borrower is going to have $1 million of COD income. And I think even though those rules are kind of complicated, if you just think about it like that does make some sense. So modifications can cause COD income. The other thing that can cause COD income is a sale of the property in foreclosure or a transfer, a deed in lieu in satisfaction of the debt. And these rules are strange. the tax consequences of transferring a property in those situations, it depends on whether the debt is recourse or non-recourse. If the debt is recourse, you have to split the transaction into two pieces. It's treated partially as a sale, so the borrower is going to have gain or loss equal to the foreclosure sale price or the property value minus his or her tax basis on the property. That's one piece. There's a sale piece. And then to the extent of any excess debt amount that's relieved, the borrower is going to have COD income. Okay, so that's the rule for recourse debt. For non-recourse debt, you totally ignore the value, and you just treat it as a sale equal to the amount of debt minus the basis. So taking a simple example, Bob borrows $5 million to buy property. Property plummets in value, goes down to $2 million at a time when the debt balance is still $4 million. He's got a tax basis of $3 million. And at that time, he conveys the property to the lender and is relieved of the debt. So if the debt is recourse, Bob is, remember, we're going to split the transaction into two pieces. So if the debt is recourse, Bob has $1 million of a loss. That's the property value minus the basis. That's $1 million loss. And then he has $2 million of COD income. That's the debt, $4 million remaining debt balance minus the $2 million he got credit for in the foreclosure. So he's got $1 million of loss, $2 million of income. Okay. If it's non-recourse, Bob just has $1 million of gain. You just take the debt balance minus the basis, and he has gain. So if you compare those situations, so in the second situation, he's got $1 million of gain. In the first situation, he has $1 million of loss and $2 million of income. If that $1 and $2 million, if they netted out against each other, it would be $1 million, and you'd be kind of the same. The problem is they're probably not going to net out because that $1 million is likely going to be a capital loss, which you can't take against ordinary income. So he's got a $1 million loss that maybe he can't really use right away, and then he's got $2 million of COD income. As opposed to in the example 2, he's got $1 million of gain, probably capital gain, which is taxed at a lower rate than ordinary income. So there's a big difference between recourse and non-recourse. It's not necessarily true that non-recourse is better because, I mean, at least from a tax point of view, because there are ways to exclude COD income, which we'll get to shortly. But just keep in mind, recourse and non-recourse debt, relief of that is taxed very differently. And it's not even really clear all the time what the difference is between recourse and non-recourse debt. The next issue that can trigger COD income is if a related party buys the debt. That will cause the borrower to realize COD income. There's related entities, related family members. So just real generally speaking, entities are treated as related if there's more than 50% common ownership between the two. Family members are related. There's a particular list, so it's spouse, children, grandchildren, parents. So if any of those related parties acquire the borrower's debt, there's going to be COD income to the borrower. And the amount of the COD is going to be the difference between the outstanding debt amount and whatever the related party bought it for. So I won't go deep into this example, but so if there was a $10 million debt and a related party bought it for $7 million, the borrower is going to have immediately $3 million of COD income. So I know sometimes people can be tempted to do this because, I'm being creative, I'm getting a related party to buy it. It can almost cause more problems than it solves. But related party, it's common ownership, control doesn't really matter. It's particular family members. So if you can find a friendly party who's not technically related, then this still might be a way out for you. The other sort of thing that can trigger COD income is converting debt to equity. And so there's slightly different rules for corporations and partnerships, but basically if you take debt and convert it into stock in a corporation, the debtor corporation, the corporation has COD income if the fair market value of the stock is less than the debt. So if you take $1 million of debt, convert it into $300 in stock in the debtor corporation, the corporation is going to have COD income equal to the shortfall of $700,000. For partnerships, the rule is much the same. if you convert debt into a partnership interest, partnership is going to have COD income if the value of the partnership interest is less than the debt. Um, the regulations give, in a partnership context, they give the parties a little more flexibility to set the value. So that's an advantage. A disadvantage, though, is if the creditor is already a partner in the partnership, which is common. You've got partners, loaning money to the partnership. If there's COD income to the partnership, some of that is going to be allocated through to the pre-existing partner. So you could have a situation where you've got a creditor agrees to reduce the debt amount. Their COD income is allocated right back to him. So you got to be careful with partnerships. Okay, so what we just talked about were the situations that could trigger COD income. So now what I'll talk through just briefly is what are some exceptions to that, some exclusions. The one is COD income may be excluded from income if it occurs in a Title 11 federal bankruptcy case. Skipping down to the second requirement, it says the debtor must be under the jurisdiction of the bankruptcy court as the Title 11 debtor. And so it's not enough just to be under the jurisdiction of the court. You have to actually be the debtor. And so as a practical matter, this exception really isn't going to help you if it's a partnership, multi-member LLC that's going bankrupt, because unless you can have COD income for the partnership, it's going to flow through to the partner. If the partner is not the one who's the debtor and bankrupt, this isn't going to help the person. So really this bankruptcy exception is really only going to help C corporations and individual debtors who are individually going bankrupt. Another exception is for insolvency. This is a little more flexible. So COD income can be excluded to the extent the debtor is insolvent. A debtor is insolvent to the extent its liabilities exceed the fair market value of all of its assets immediately before the discharge. And then to the extent that the debtor is solvent, he's going to have COD income. So this applies at in the case of a partnership or an S corp, it's going to apply at the partner or shareholder level. So even if you're having this income, COD income triggered at the partnership level, you can only use the insolvency exclusion to the extent the partner is insolvent. So just a real simple example, debtor realizes $3 million of COD income from a debt modification. Immediately before that modification, debtor had liabilities of $5 million, total assets of $3 million. So in that situation, the debtor's insolvency is the difference between the 5 and the 3. That's $2 million. And so of the $3 million COD income, only $2 million can be excluded under this exception. The remaining $1 million has to be taken into income and paid tax on. So these are phrased as exclusions, but at the end of the day, in most cases, they end up being more like deferrals because this exclusion is not totally free. The debtor has to reduce other sorts of tax attributes they may have. And so there's a bunch listed here, but eventually you get down to basis of property. So you exclude the COD income, you then have to reduce the tax basis of your property going forward, which means when you turn around and sell the property, you're going to have more gain. So effectively, this exclusion just ends up being a deferral, which is good, but it's not something for nothing. Another exclusion is for qualified real property business indebtedness. Debtor can exclude COD income from the discharge of debt that's used to buy or improve real property used in a business. And that debt also has to be secured by the real property. So if you have COD income relating to that type of debt, then you can elect to exclude that income, but there are limitations. The first limitation is total loan amount less fair market value of property. It's the lesser of that or the tax basis and only the depreciable portions of the property. And if you exclude income under this exception, then you've got to reduce the basis in the depreciable property. Just a quick note on this. C corps cannot take advantage of this election. And this is applied like those other exemptions at the partner S corp shareholder level. So just a quick example, debtor buys $10 million property subject to $8 million mortgage. After he pays it down by $1 million, property value declines to $4 million. The lender agrees to reduce the debt down to $4 million. And then tax basis of land is 6, building is 2. So total COD income in this case is $3 million, difference between the loan balance and then the new loan balance. The excludable amount is the lesser of the difference between the $7 million and $4 million property value, so $3 million, or the basis of the building. Because that basis of the building is lower, it's only the $2 million that can be excluded. And so the trade-off here is the debtor reduces their basis down to 0 in the building, excludes that $2 million, and then has $1 million of income. Sort of skipping through some of these. There's an exclusion for qualified principal residence indebtedness. Debtor can exclude up to $1 million of COD with respect to their principal residence. For married filing joint taxpayers, that's $2 million. And with all these exclusions, you can't get something for nothing. And so if you exclude COD income here, you have to reduce the tax basis of your residence by the excluded amount. Another exclusion was that PPP loan program, which is in the press a lot. According to those rules, the forgiveness of the PPP loan does not result in COD income. However, the IRS has also come out and said that any expenses you pay for with those proceeds, you can't claim tax deductions for those, even if they're otherwise deductible. So here's just another example. You can exclude COD income, but you have to give up something else somewhere else. Okay, so that was for borrowers. Like I said, that's where most of the issues are. I just wanted to talk just quickly, though, about some issues for creditors. When we're talking about the lender who's the original lender, then that lender's generally going to have a tax basis in the debt equal to the outstanding principal amount. And so if there's a modification or settlement of the debt at something less than the outstanding principal amount, then the lender's going to have a loss. And so it's just the treatment of that loss, which is going to be the main tax issue for the lender is the original lender. A lender who's regularly in the lending business, that loss is probably going to be ordinary loss because there's generous rules that applies to banks and financial institutions. If this debt, though, was made by someone who's not usually in the lending business, sort of as an investment, then the loss resulting from a settlement of the debt at less than full value will in many cases be a capital loss. But those are the issues that you'd have to worry about if you're the original lender. There's much trickier issues if you're a creditor who acquired that debt instrument on the secondary market. So if you want to go out and buy a distressed debt instrument, I'm sure there is or there will be investment opportunities there. But you have to be very careful, because if you go out and buy the debt by purchase on the secondary market, you're going to have an initial tax basis equal to what you paid for that debt. And so, if you get paid on the debt, if you collect on the debt more than what you bought it for, you're going to have a profit. That was the whole point of it. That would be why you invested in it, right? But there's all kinds of things that can trigger that gain unexpectedly. And so one of these situations is a significant modification situation. We talked about that in the case of borrowers, where if there's a significant modification of the debt, that's treated as swapping one debt instrument for another. So generally, that's not going to cause a problem for the borrower, but it could cause a problem for the person who bought the note on the secondary market. Taking a deed in lieu of foreclosure is going to trigger gain equal to the fair market value of the property minus the tax basis in the debt. So if you buy a distressed debt and you foreclose on the property when the property is worth more than what you paid for the debt, that can trigger gain. In both of those situations, you're not going to have any cash to pay the tax. And so these are situations to be careful of. there's also these market discount rules. Those are kind of complicated, but that can cause the gain to be taxed as ordinary income when it would otherwise be capital. So just taking as simple of an example as possible, Sally pays 12 million to buy a distressed debt instrument, severely distressed. The outstanding principal is $22 million. So after a couple of years, she agrees to reduce the principal to $20 million. So we're talking about Sally, right? The holder of the debt. All she did was reduced the principal amount as the lender. But because her basis is so low, that reduction in principal, it's a substantial modification. She It's treated as her swapping one debt instrument for another. The issue price of the new debt is the $20 million. Her tax basis on the debt she bought was $12 million. So that reduction of $2 million causes her to have taxable gain of $8 million. So that's kind of crazy, right? This is the creditor we're talking about. All they did was trying to be nice to the borrower, and they're hit with this huge tax bill. So just my point here is just be careful if you're buying debt on the secondary market. There are things that can cause you to be taxed unexpectedly and without cash. So I wanted to leave time for questions if there are any.